What is up, everybody? Welcome back to Never FOMO, the channel where we talk about all of the investment options for you, regardless of the asset class. So, whether that's real estate, stocks, bonds, mutual funds, cryptocurrency analysis, if you like to make money and be wise with your wealth, you are in the right spot. So, today I'm going to do a little bit of a different show. I usually talk about one specific asset at a time. Perhaps I'm talking about the real estate market. Occasionally, I've talked about cryptocurrencies and individual projects. But I wanted to kind of touch on something that a few folks had asked me about, which is which asset class should I invest in? Or what percentage of asset classes should I invest in? And so I thought it was worth doing a short video to discuss a well-diversified portfolio. Now, I'm sure you've heard the term diversification, and you've probably heard people say that you should have a well-diversified portfolio. But what the heck does that really mean, right? Depending on who you ask, you'll get different answers. So I'm going to give you Walt Key's version of a well-diversified portfolio. And before I begin, let me just say two things. One, like, subscribe, thank you so much. Two, this is not financial advice. I am not a licensed financial advisor, and so everything I tell you is Walt Key's opinion based on Walt Key's experience in hopes to help you be successful. With that said, let me reiterate, I'm not a financial advisor. Like and subscribe. Let's get started. All right, so today I'm going to show you, I kind of broke out some basic stuff here. So this is a pie chart, because who doesn't love pie, right? Showing a percentage of the assets I hold in relation to my net worth. Now, I don't put numbers on here because, frankly, you don't need to know how much money I have or how much wealth I've built. It's not important. The important thing is that you see the percentages. A well-diversified portfolio has different meanings depending on who you speak to. If you're talking to a real estate professional, they're going to tell you a well-diversified portfolio might mean multiple pieces of property in different locations so that even if one area doesn't do well, the others will. A stock investor will tell you that a well-diversified portfolio would be a variety of different stocks in different industries. So if one particular industry is having a rough quarter, the rest of your portfolio would still perform well. A mutual fund advisor might tell you that a well-diversified portfolio is a mutual fund that has a variety of different company stocks in it, touching on multiple industries, perhaps even touching on bonds and cash as well as company stocks in order to diversify your investments. Now, I'm going to talk about all of those because I'm bringing this to you from the perspective of the individual investor trying to build wealth, trying to retire, trying to do what they want to do with the rest of their life. I believe that a well-diversified investment portfolio not only touches on everything I just said, but also includes all of those different asset classes that I just spoke about, and not any one particular asset class. So while this is not perfectly fine-tuned, to the 10th of a degree, this is an accurate representation of my current portfolio, which assets I hold, and how much of those assets make up my current net worth. Now, as you'll see, real estate right now is the bulk of my net worth. Now, that's not necessarily because I love real estate and I think it's the better investment of every other class. It's simply because I've been a real estate investor far longer, and by sheer time and the amount of real estate I hold and the equity I've built, the equity position in my real estate holdings is a substantial part of my net worth at this moment. I'm newer to cryptocurrency. I don't use a lot of individual stocks, so naturally those percentages will be smaller. But as time goes on from this moment, my cryptocurrency portfolio will quickly begin to take up a larger percentage of my net worth because the value of my crypto portfolio will grow substantially faster than my real estate portfolio or even my mutual fund portfolio. So 89% roughly right now is real estate. I'm going to break all these down in just a moment. 7.5% roughly is mutual funds. I have mutual funds in two specific retirement engines. I have my Roth IRAs, and I have a SEP IRA that I run my business through so that we can put additional income into investments. Crypto's about 3% right now. And again, I will break down exactly what that looks like for you. And then individual stock holdings, not mutual funds, not professionally managed, but individual stocks that I have bought and hold make up roughly 0.5% of my net worth. Now, let's talk about real estate while we're on the slide for just a moment, and then we'll keep going. I hold multiple types of real estate. I believe that there are great investments, there's great deals to be had across the various ways you can invest in real estate. And if you remember my video that I did about how to analyze a real estate deal not too long ago, feel free to reference that one in the playlist. I talked about long-term holds, short-term rentals, fix and flips, etc. I currently hold long-term rentals where I have a 12-month lease and people are renting from me, as well as short-term vacation rentals similar to Airbnb, VRBO, etc. And so I have two of really the three different types of real estate that you can invest in my real estate portfolio at this point. I'm not picky, I like them all. Okay, let's move on real quick. Let's talk about mutual funds. It's 7.5% of my portfolio. What you're looking at here briefly is by nature diversification. I have multiple asset classes in my total net worth portfolio. That alone is the definition of diversification, not putting all your eggs into one basket. It's an interesting term that your grandparents might have used back in the Depression era when if you dropped a basket full of eggs, you probably wouldn't have anything to eat. And so you didn't put all your eggs in one basket. That's literally what it means. In this case, we diversify our investment money across multiple assets. So if for some reason the stock market does poorly and mutual funds are not returning a good gain, I still have inflation working in my favor with my real estate assets. Or if my mutual funds are not doing so well, at least I still have renters paying my mortgage and my cryptocurrencies may be doing very well. So this is us putting our eggs into multiple baskets. Okay, let's move on to mutual funds. Now, I don't have a ton of different mutual funds because mutual funds by their very nature are well diversified if you pick them properly. I hold two specifically, and these two are broken down on the slide in front of you. MFS Growth and Franklin Dynatech. As you can see, they are diversified within the actual fund across multiple sectors, multiple different industries, and there's some similarities. You'll see technologies 39% and 33%. However, industrials is 5.5% with growth. It's not even a percent with Franklin Dynatech. So I have great diversity among the different asset sectors in the stock market. Both of these mutual funds hold shares of different companies, and sometimes even within the same sector, they still have different companies within the sector that they're investing in. So that's great diversification amongst each fund. And then I have the two separate funds because the Franklin Dynatech focuses, as you can see, a little bit more towards the technology play, which I believe is doing very well and probably will over the next 5 to 10 years. And so I really like Franklin Dynatech. I put that one in my SEP IRA. MFS Growth Fund I have in my Roth IRAs. And you can see they've both done really well. I realize that my face is going to cut off at the bottom right of the Franklin Dynatech, and I'll show you that. That's okay. This is the percentage of growth broken out year to date, meaning so far in 2021. The 1-year return, 3, 5, 10, and even 15-year return. Now you'll see that a 15-year return of almost 12.5% is outstanding for a mutual fund. I didn't pick this one by happenstance. I did my research first, which I always tell you to do, and I found funds that were beating the indexes, beating the sectors, and I invested my money in the winners. And you always want to look long term. Don't look at a company or a fund that might have done really, really well in the last year, but has no track record long term. These both have been around for many decades, and you can see their 15-year average return is well ahead of what most people think is possible in the stock market. So these are great. I know you can't see the percent of return on the 15-year on Franklin Dynatech. Their 15-year return is 14.1. And so it's even better than the MFS Growth. Okay, so mutual funds, well diversified inside the funds. Both of these are what are called large cap growth mutual funds. They focus on growth stocks, and they don't put a lot of money into cash. They don't put a lot of money into bonds. They are primarily in the stock arena. And so roughly 96 to 99% of everything being invested inside these mutual funds is going into stocks, specific companies that they have selected that they feel will do well within the sectors, and that's where they invest. There are other types of mutual funds. These are growth funds. There are income funds. There are funds dedicated towards preservation of assets, which typically hold a lot more bonds and treasury bills, which are consistent, but they don't earn you a lot of money. And so what mutual funds you're in will depend on your risk tolerance and what phase of your life you're in. I personally believe that good quality growth stock mutual funds are a phenomenal way to build your wealth as well as hold your wealth as you get nearer your retirement years. Okay, mutual funds. Let's move on to the next snippet, which is crypto. Now, this particular pie chart does not exactly accurately represent all of my percentages of holdings in these. I did this because it's a close representation, and quite frankly, I didn't feel like spending the time crunching the data points to build the proper pie chart, but I found this image specifically because it was close. The vast majority of my crypto holdings, not quite 50%, are in Ethereum because I believe that is one of the most stable and most long-term value add plays in the crypto space right now. And so I have a larger portion, and by nature it's a more expensive crypto, and so there's more money involved in that. Cardano is a close second to Ethereum, and quite frankly, I believe at this point there's probably a better chance of higher returns on Cardano in the, let's call it, the next 6 to 9 months than there are with Ethereum. But even so, I believe Ethereum still probably has room to 3, 4, 5x before the end of the year. VeChain is a great little project. It's relatively new, but I have a lot invested in it because the space that they're disrupting, the technology they're bringing to the table, the industry itself, all of the partnerships that they're building are going to do wonders for VeChain. And so I am very bullish on VeChain, similar to Harmony. Okay, Binance Coin and Crypto Coin. I don't have near as much of those. Honestly, I use the Binance Coin primarily because I use that as my trading mechanism for the other microcap tokens that I buy occasionally. I swap a Binance Coin for those, so I always hold a little bit of Binance Coin to the side. And then Crypto Coin, CRO, is the official crypto of Crypto.com, which is one of the largest crypto brokerages that exist. Now that Coinbase has gone public, Crypto.com or Binance will likely be the next to go public, and those coins have a really solid future ahead of them as well. And so I keep little bits of holdings in both Binance Coin and Crypto Coin for those reasons. And then lastly, the microcaps, the dark blue. Now understand that no one specific microcap project holds more value than Binance Coin or Crypto Coin or Harmony, etc. I do have multiple small microcap projects. So of the 9 or 10 or so that I have, those actually collectively equal more value than some of my other smaller holdings like Harmony and Binance Coin and Crypto Coin. But the individual projects I have a very small amount in, because if you remember the video that I just made talking about microcap projects that might do very well, I was very clear that they're more risky. They're one of the most risky investments you can make in the crypto space. And so you don't want to have a lot of your money in that. If they do really well, they will quickly become a larger portion of my crypto holdings, at which time I will shuffle my crypto holdings, pull some of my microcap profits off, distribute it into my other crypto projects, and rebalance my portfolio so those projects never become a huge portion of my holdings, because if they decide to not do so well anymore and I start losing money, I don't want to lose huge percentages of my money. So that's how you play those. So that's roughly what my crypto holdings look like. And then for individual stocks, while I realize this pie chart is incredibly simple, it's actually fairly accurate, and that's why I threw it on here. I have right now multiple individual stocks that I autocorrect, sorry about that, that I invest in, and they are currently across 4 different sectors. I have some stocks that are in the agricultural section, some hydroponic related farming stocks, some that are in the communications sector doing CDNs and content delivery, streaming services, some technology stocks, and then some healthcare stocks, some biopharmaceutical stocks. These are smaller companies that are working on, key drugs in certain industries. And then if they get FDA approval for their new drugs, they could do really well. But so those are the 4 stock sectors are, and there are multiple stocks within each of those sectors, but I roughly break it into those 4 sectors. As of right now, if I find another stock that I really like and I add it to my portfolio, it could very well be in another sector. I'm not limited to this, just these sectors. But this shows you what I'm in right now, only to highlight that within all aspects of my investment portfolio, I am diversified. I am diversified across multiple asset classes. Within those individual asset classes, I am diversified even further with the different types of that asset. And within assets like mutual funds and individual stocks, I am diversified across multiple industries and sectors. So if any one industry or sector has a bad quarter or a bad year, the others can buoy my investments. Hopefully that makes sense to everybody. If you have any questions at all about how to build a well-devised portfolio, diversification is key. If you have questions, let me know. Happy to help. Drop a comment. If there are other asset classes you're interested in adding to your portfolio, like bonds or gold or T-bills, there's a whole bunch of them out there, let me know. I can happily make a video on those as well. Quick note, you'll notice I've got my awesome blue Hawaiian shirt on. I just thought it was interesting. I wanted to wear it today. This is actually the shirt that I got married in almost 19 years ago. My anniversary is on May 16th. And so in just a couple days, it'll be 19 years from the day I put this on and said my vows. And magically, it still fits. I'm not sure how that worked out. Pro tip, run some marathons in your life. That'll keep you thin. But yeah, so my anniversary is in a couple days. Happy anniversary to me and my beautiful bride. She keeps me young. That's all I got for you today. Before I hop off, I do want to just show you, because a lot of people, mutual funds are a great investment tool, and they're one of the easiest ones you can get into. And so if you don't have $100,000 or $500,000 or X amount of dollars to throw into real estate, and you're not quite ready to dive in and do some crypto, and individual stocks are just too technical for you to feel like you're comfortable with, the mutual fund is probably your friend. It's probably going to be the best return on your investment without you having to be really, really in the weeds on the data. So let's talk a little bit more about mutual funds. What you want to do is investigate the mutual funds that are out there in order to find the ones that consistently outperform their peers. Just like individual stocks, just like individual crypto, there are many, many mutual funds out there, and they're not all managed as efficiently. They don't all focus on the same things. And so some do better than others. If you can pull a 12 to 15%, 15-year return, that's going to be great. One website that is incredibly helpful for individuals to break out mutual funds is Morningstar. It's morningstar.com, and you can look at the fund, who runs it, how long have they ran it, how long has the fund existed, what are they doing in relation to the index and the categories they compete against, etc. So this is Franklin Dynatech, the one that I have my SEP IRA invested in, and I'm currently sitting on the performance tab. You'll notice that they have consistently outperformed the index in which they exist and well outperformed the category in which they exist. That's important, because if you're looking at, here's that 15-year, 14.1, and since they were created, 10.3 back in the 1968. So for decades, this has averaged over 10%. That is quality. That's important to know. You can also look at the portfolio tab on any of these mutual funds. So here you see that it's weighted towards large cap growth, like I told you earlier. US equities, that's US stocks. Non-US equities, that's non-US stocks, makes up approximately 99.5% of the portfolio. It is a stock-heavy, growth-focused fund. Nothing wrong with that. You will find other funds that are more asset preservation minded. They'll have more cash, they'll have more fixed income, they'll have other things. As you scroll down, you'll see the sectors that they were in, which I've already shown you. You'll see some sustainability ratings, which are good to know. And then if you really want to break it down, you can look at the individual company holdings that that mutual fund has. So in this case, MFS Growth A, their top 10 holdings are Microsoft, Amazon, Alphabet, Adobe, Facebook, MasterCard, Visa, PayPal, Apple, and Thermo Fisher Scientific. Very technology heavy on the top 10. A couple of those are in the financial sector with Visa, MasterCard. A couple of those are in other sectors with like Adobe and Thermo Fisher Scientific. And you can break down all of the different classes and see how they break down. This is a great starting off point to evaluate mutual funds to see if you might want to invest your money into those. Morningstar rates their funds 1 through 5, 5-star being the best. If you click on people, it will actually show you who runs the fund, how long have they ran the fund, etc. So you can see for Franklin Dynatech, there have been 2 managers with a 53-year tenure, collectively 35 years on average. That means the folks running this fund have been running this fund for a very long time. They're being very consistent, and you have a long-term track record of them proving successful. That's important to know. If you look at a mutual fund and it's only got a small, maybe 3 to 5 year average tenure of the managers, there could be a lot of changes in that mutual fund. And so those long-term trends might not hold true in the future because other people are now at the helm. Okay, so I don't want to dive too much more into that. I just want to let you know Morningstar.com is a great place to evaluate mutual funds so that you can start to diversify your portfolio. Mutual funds are really the foundation, right? That's a great place to start. Roth IRAs, individual brokerage account, SEP IRAs, 401ks, 503bs, all of those are going to allow you to invest in good quality mutual funds that should become one of the foundations of your investment portfolio after you've paid off your debt, after you've saved for a rainy day, after you've done all those other things that I talked about in my Never FOMO wealth building plan, which you're welcome to look at again in the playlist. All right. Hope everyone has a wonderful day. It's midweek. I don't usually do a Wednesday, but I'm going to be busy later this week with my anniversary stuff, and I just wanted to get this one out there. It's important to understand that no one asset class is better than the other. Within all asset classes, there are good investments and there are bad investments. And so it is incumbent upon you to be able to do the research, know what you're investing in, and be comfortable where you're putting your money. And if you're not comfortable, if you don't understand the investment, by all means, don't put your money into it. Get the knowledge you need first before you invest your hard-earned dollars. Okay, that's all for now. Thanks so much for tuning in. Hope you have a wonderful week. Let's go make some money.